Alrighty guys, so in today's video, I wanted to take you through a live trade that I took today. It's a recorded trade. I want to talk through why I took that trade, why I mentioned this area to my Discord, and what were the confirmations to take it. So for me, if you're new here, my name's Ruben. I mainly trade ICT Macros and I have been doing so for around 1.5 to 2 years. And in that time, the thing is, I've tried all strategies, but this is just what I've kind of stuck to. And I find consistency with this model in all sessions. In this case, it's the Asian session, but with my premium Discord, I do live market reading. That's for the London session. And if you trade the New York session or PM session, just know that what I'm teaching here also applies for those sessions. You're still looking for these key concepts. You're just applying that to the particular session that you trade in. Now, coming into the day, I like to really see what the previous session's done. So if I'm trading the Asian session, I need to see what the PM session's done, also what the AM session's done. I want to know what kind of range we've created and also where the market is closed and where the market has opened. So for example, if I now just get the screen up here, this is for my premium Discord. I talk about how we've got the range high, we've got the range low. So have a look on the screen here. I've talked about the range high, the range low. And essentially all I'm asking myself is this: where does price close in that range? And if you have a look on the screen here, the price closes towards the bottom portion of that range. So automatically, like I tell the Discord, I'm looking for longs, right? I'm favoring longs because we're in the top portion of that range. And this is something I use very heavily if you're taking notes. If we are in a level of discount at the bottom portion of the range, I'm probably looking for longs. If we are at the very top of the range, I'm probably looking for shorts. And that's just how I roll. Now, as we're watching the price action, I mentioned this specific point and I say, if no reaction happens from this area, I'm going to be patient and I'm going to observe the low marked in red. But what is this low? And that might be a question you have. What is this low marked in red? What is this? This is the low. If I zoom up here, this is the low that was formed yesterday during the New York AM session. So if price doesn't respect the halfway point of this wick, then I assume we're trading towards this low and I'm looking for reactions from that point. And this now gives you a bit of context, of course, because as we go back here, we can see that this is the red line, and this red line that you see on the screen is actually the previous session's New York AM session low. Simple as that. So we sweep that, the macro sweeps that low. I'm now looking for an inversion fair value gap. Price creates it. We've got it right here, a really nice impulsive gap. You're looking for impulsive candles. I tell this all the time to my Discord. Impulse candles, impulse candles, impulse candles. Big candles, right? Big green candles, you want that. You can see I enter that trade. I'm pretty happy about that, and it's all pre-planned. Now, where are my targets? What am I targeting? Well, for me, in this case, I've only entered in with one contract. So if I've entered with one contract, I'm usually not going to hold that. If I'm in with one contract, I'm risking 300 to 400. I'm going to take my profits roughly at about a 1-to-1. If I'm able to take two contracts because the stop loss is smaller, then I'm probably going to hold a 1-to-1, take a partial, and then move my stop to break even. And then from that point, I may hold runners. That's kind of how I like to roll. That's how I like to do my risk management. It's what I preach. Take a base hit, move on, makes your life much easier. And really at this point, I was pretty confident because look at how, if I just stop this, look at how we accumulate here. We manipulate into that low. But look at this wick. Look at this wick right here. Look at how price comes down. We sweep that previous AM low and then we close back in. We come down, we sweep, but we immediately displace back to the upside with impulse. Now this is using the macro. This is using the power 3 concept. This is using the macro and power 3. It's also using the concept of we're sweeping a previous day or previous session low, and I anticipate an abrupt and quick reaction after these things happen if you're writing notes. So I'm going to drop little gems today as it comes to my mind. No editing today, just off the top of my head. Now, as price is playing out, I'm not really too concerned. I'm not looking to pyramid in because I don't want to risk $700 on this trade. Could I use micros? Of course, but I prefer to use minis. And I've always just done that, either one mini or two minis, depending on the size. Risk in between 200 to 500 per trade. Happy days, we move on. So price begins to play out. Let me just go to the middle of this trade here. Now, normally, typically at this point, I would probably move my stop to break even. The reason why you don't see that here is because I couldn't really monitor the charts closely. I was doing a few other bits and pieces, had the laptop there, I was watching it loosely, was doing other things. So I was pretty confident we'd get to that draw. If price started to come back down, I would have mitigated my stops. But I tell people all the time, if you approach that target, if you're in with one contract or two contracts or 3 micros or 5 micros, whatever it might be, when you are approaching that target, you have to manage risk. You should mitigate risk, because why would you want price to come all the way up here and then come down and stop you out for full stop loss? It's not worth it. You might have to, here's the thing, you might have to realistically take multiple losses to then take a win. So now if you made it this far, you get a little sneak peek into my stats for this week. Now on the screen, there's a few things I want to talk about, because I've just mentioned that it is important to mitigate your stop loss. This is how I do it. You might find it differently, but for me, I always preach to mitigate stops. If we have a look at these days, right? London session this week's been really, really nice. Asian session has been okay, right? Both have been profitable weeks for each of these accounts, and you can see the amount of trades I've taken here. Now, in some situations, I've taken 1, other situations 2, 3, 4. But how does this happen? How do I take 4 trades? How do I take 3 trades with a 33% win rate on Monday, but still have a profitable day or break-even day? Risk management. Going to break even, reducing my stop loss, and not aiming for too much. Right? On this given day here, I took 2 losses to start. The 3rd trade was purely to get me back to break even and a little bit of profit. Really quick, really clean. So 1 trade and done. 2 trades and done. 3 trades and done. Doesn't always happen that way. And this is the reality of trading. So when you're collecting your own stats, it's not realistic to have an 83% win rate every single week if you're taking trades every single day. It's not going to happen. But for one given week, of course, for 2, for 3, for 4, potentially, depending on what sequence of trades you get, it's all probability, right? So 58% here, pretty happy. London session, probably going to leave this week because of the fact that I've had a good week. What's the point of ruining that win rate? What's the point of putting more risk on the table? And these are things that are really important before we get into the next portion of the video. Risk management is what will save you. Risk management is what will allow you to stay in the game for longer. And today in the Asian session, this is the trade that I haven't added yet. And today we're at 100%. One and done, right? So overall this week in the Asian session, 67%. Overall in the London session, 83%. Really good week. You don't need 80, you don't need 60%. You could have a 45, 50% win rate with a decent risk to reward, and you're still gonna have profitability. With that being said, let's get back into this main video. So when I'm looking at price action here, I'm not too concerned. Letting price do its thing. And price did actually sweep this buy side. And the funny thing was that it swept the buy side. I wasn't looking at the charts. When I came back to the charts, we just retraced back down. So I took my profits. You can see that reaction, really nice, pre-macro accumulation, pretty easy trade to take. And I think somewhere about here, we take that buy side. So there we do. Now, if we go back, I just want to actually play this out. When we have this accumulation, when we have this price movement where we're just slowly grinding like this, slowly moving up, slowly moving up, slowly moving up, slowly moving up, I'm looking for a pop. I'm looking for an impulsive move. I'm looking for an expansion higher. When you accumulate, you expect an expansion. If the move, as you can see, is already bullish, do I really want price to come back down like this aggressively? Probably not. I want to see price expand through these relative equal highs. That's what I'm anticipating. So when you talk about risk management, I talk about risk management, people talk about this. It's more than just mitigating your stops. It's also being able to read price structure and being able to, based on your data collection, anticipate what you'd like to see. If price aggressively closed down here, I'm moving my stop. If I was to get stopped at break even and price reacted from this inversion, I would look for a re-entry in the next macro. It doesn't bother me. Making money in trading, guys, is easy. Losing money is easy. Keeping money is hard. And that's what risk mitigation is and risk management. You can see how we just peeked through. I wasn't on the charts. That there would have been a good TP on that nice impulse candle. As price comes through, obviously I'll take that off. And it's a pretty easy trade, right? This trade framework, this trade idea is based on the idea of looking for session-based liquidity. Now, if you've made it this far, congrats, because I'm going to do a little bit more of a deeper dive into the charts, just as what I was looking at in terms of the highs and the lows, talking about ranges, everything in between. And what I want to do is start off with the 15-minute chart and just show you what I mean by the range. I think this is pretty obvious, but it's important that you understand the concept of ICT's dealing ranges. So I've marked out the high here in blue and the low here in red. Why is this a dealing range? This is a dealing range because of the following. Number one, this swing high has swept buy side liquidity right here, right? I'm going to make that blue, number one. And this swing low has swept sell side liquidity, right? So I'm going to make that red, and I'm going to make this one here blue. Therefore, from swing low to swing high, we have a dealing range. And this is where you might see ICT, I do this myself. You can draw a box in that range like this, and you can look for areas of premium and discount in that range initially, right? So the initial idea for me was to look for longs when we're sitting in this lower portion, being a level of premium. Now, because this swing low has swept more liquidity, I now would consider this my dealing range, like that. It doesn't change much, but that's my dealing range. And what this means to me is that we're still in the bottom portion of this dealing range. We still have unmitigated fair value gaps in this 15-minute space. See this 15-minute chart? This bearish gap right here, this bearish gap right here, these could become a draw. We can have an accumulation and an expansion. So at this point, because we're sitting very low down, really low down in the range, I would not be interested in shorts. Shorts have happened already. I'd be looking for longs. Longs towards where, you might ask? How do I get a narrative for the London session, for example? Because right now it's about 40 minutes until the London session. I'd automatically look for longs, but why is it the case? We're in the bottom portion of this dealing range. And in doing so, I'm now thinking to myself, okay, what is the chance that price may want to tap into this fair value gap and also might want to tap into this fair value gap? And I'll weigh it up. Right? Yes or no, or what's the probability? High, low, medium, in between. Based on the fact that we've swept a previous day low from a previous session, based on the reaction that we've had down here during the macro. By the way, I'll scroll up, guys. You can see this candle is formed at 8 o'clock. What's 8 o'clock? A macro. Really important. And look what price is doing here. So when I'm trying to build a narrative, I start with a 15-minute chart. I mark out the range that we're currently sitting in. If there's a really clear dealing range, like you can see here, then I draw that out and I'll mark that out. That's really, really important. If we're at the lower portion of that range, I look for longs typically. If we're at the top portion, look for shorts. And you know what? If price sold off more, I'll just observe to see what happens if we sweep the Asian lows. And again, I'd apply exactly the same concept that I did for the Asian session trade. The Asian session trade swept previous session liquidity. If we came down lower, it'd be the same thing, sweeping previous session liquidity. So I'm targeting longs. I think longs are more favorable. Even if price came down, I'd still be looking for longs, and we'll see how this video ages. Those are my ideas, but again, we're waiting for the market to show us those signatures. You start with a 15-minute chart. As soon as price sweeps that low, you drop down onto the 1-minute chart and you look for entry confirmations that suit your narrative or suit your model. In this case, I'm purely looking for an inversion gap. That's all I need. I've got the higher time frame structure, the higher time frame range. I'm waiting for that inversion gap to form. When that forms, I'm in. I'm confident. I've got my draw. I've pre-planned this. I'm going from the higher time frame down to the lower time frame, so I've got multiple backings there. And last thing I need to make sure, do I have a clear draw on liquidity? And the answer is yes. Swing high, swing high, swing high, swing high, swing high, swing high. And we have imbalances up here that are unmitigated. So that's going to conclude this video. Bit of extra sauce there. If you guys like this style of video, me going through live trade recaps, maybe a bit of market analysis, I like doing this. And hope everyone has a great weekend. I'll probably post this on the weekend or just after. And if you've had a good week, great. If you haven't, journal, collect data. There's always next week. If you want to join the community, the link is in the description. Free and paid. We'll talk soon. Peace out.